Every financial era has its defining illusion. In the early 2000s, it was the belief that housing prices could never fall. In the 1980s, it was the idea that Japan's economic rise would last forever. But today, the most dangerous illusion of all is quieter, more technical, and far larger than anything humans have ever built. It is the assumption that the global derivatives market, now swollen to more than $600 trillion in notional value, is stable, contained, and safely engineered. Most people will never see a derivative contract in their lives, yet derivatives silently dictate the price of their mortgages, the stability of their pensions, the interest rates that determine the cost of credit, and even the survival of the banks they depend on. And in this silent architecture lies a problem the world has never truly confronted. To understand why this system has become a time bomb, we must start with the strange fact that derivatives were originally created to protect the world from risk. Farmers use them to lock in crop prices. Airlines use them to hedge the cost of fuel. Banks use them to stabilize interest rate exposure. But the moment Wall Street realized that risk could be packaged, recombined, multiplied, and sold, derivatives stopped being mere insurance and became the most powerful financial amplifier ever invented. What was once a seatbelt turned into a race car engine. The financial crisis of 2008 was the first time the world got a glimpse of what happens when this engine spins out of control. Back then, the meltdown was tied to a single sector, U.S. housing. AIG, Lehman Brothers, and several major banks collapsed because they used derivatives to insure enormous piles of mortgage debt that suddenly turned toxic. But here is what makes the current era fundamentally different. The scale is incomparable. In 2008, the derivatives market was roughly $60 trillion, and today it's 10 times larger. And unlike 2008, the risk is no longer concentrated in one asset class. It is woven into everything: interest rates, currencies, government bonds, energy markets, corporate debt, and even the plumbing of international trade. Modern finance has become fully dependent on derivatives, sometimes without even realizing it. They are the invisible skeleton holding up the global banking system. A bank in Europe may rely on interest rate swaps to survive negative rates. A pension fund in Canada may use derivatives to chase higher returns. A corporation in Asia might depend on currency hedges to pay suppliers. These contracts create a hidden web of obligations stretching across continents, where the failure of a single counterparty can trigger shockwaves in institutions that have never met each other. At the heart of this web sits a dangerous structural truth. Derivatives allow institutions to control massive exposures with very little actual capital. A bank can use a small upfront margin to take a position worth billions. A hedge fund can multiply risk dozens of times over. And clearinghouses, the supposed safety hubs of this system, concentrate risk in a way that no one fully understands. This means the true fragility of the $600 trillion machine is not visible on any balance sheet. It's embedded in the promises institutions make to one another, promises that only work if every player remains solvent, every margin call is met, and every assumption about market stability holds true. But markets do not remain stable. History shows that crises erupt not because numbers get big, but because confidence breaks. And the architecture of today's derivatives market relies entirely on confidence. Confidence that interest rates won't move too quickly, that currencies won't swing violently, that governments won't default, and that banks won't fail. Yet each of these assumptions is under pressure in ways unseen since World War II. Inflation has returned, sovereign debts have exploded, and central banks are tightening and loosening liquidity in unpredictable cycles. The world is standing on an engineered structure so complex that even experts disagree on how it actually behaves under extreme stress. Regulators believe the system can absorb massive shocks because mathematically it was designed to. But mathematics doesn't account for human panic, geopolitical chaos, or cascading failures triggered by something as simple as a sudden spike in rates. We are left with a paradox. The same instruments built to stabilize the world have become the very reason it may break. This is the hidden architecture of the $600 trillion machine, an interconnected, highly leveraged ecosystem operating on trust, precision, and hope. And like every machine pushed beyond its intended limits, the danger lies not in any one component, but in the moment the entire structure begins to vibrate. If the $600 trillion derivatives machine is a time bomb, then part 2 is about understanding the wires inside it, how each one was added slowly, rationally, and with the best of intentions, until the entire structure became too interconnected to ever be dismantled. Modern finance did not create this monster overnight. It was built piece by piece, innovation by innovation, regulation by regulation, until the system reached a point where no one could turn it off without collapsing what it supports. This is the paradox. The world needs derivatives to function, yet those same derivatives have grown so large and complex that they now threaten the system they were designed to stabilize. It begins with a simple idea: leverage. A derivative allows a bank or institution to control an enormous financial position with only a fraction of the capital normally required. That leverage can multiply profits, but it also multiplies losses. Over time, the financial industry realized that if one layer of leverage produced good returns, multiple layers would produce even better ones. And so, swaps became portfolios of swaps. Portfolios became structured products. Structured products became synthetic versions of other structured products. The result was a tower of interconnected risks so tall that even small movements in interest rates, currencies, or bond yields could produce outsized reactions. But the greatest expansion happened in a place most people never think about: interest rate derivatives. These now represent more than 80% of the global derivatives market. Why? Because everything, mortgages, government debt, corporate loans, credit markets, depends on interest rates. When rates were stable and predictable for decades, institutions took increasingly bold positions, believing nothing could go wrong. Banks hedged their exposure. Pension funds searched for extra yield. Corporations hedged future borrowing costs. Every participant added another layer to the structure, convinced they were being prudent, when in reality they were connecting themselves to a vast, fragile network that could only survive as long as stability continued. The second key component of this time bomb is the counterparty system. A derivative contract is not a physical asset. It is a promise between two parties. That means its value is only as reliable as the institution on the other side. If a major bank, hedge fund, or clearing member fails, every contract connected to it instantly becomes uncertain. The problem is amplified by the fact that institutions rarely hedge with a single counterparty. They create chains. Bank A hedges with Bank B, who hedges with Bank C, who hedges with a clearinghouse, who hedges with several more banks. This creates a financial daisy chain where no one truly knows who is exposed to whom. In normal times, the system works smoothly. In extreme times, it can freeze almost instantly. This is also where the CTA fits naturally into our story. If you're watching this and want to understand how these hidden mechanisms shape global events every single day, from crises in Japan to currency shocks in Europe to debt explosions in the US, make sure you subscribe to the channel. We post deep, storytelling-driven videos like this every day, breaking down the invisible forces shaping the global economy. If you want to stay ahead of the next big shock, this is the place. Back to the narrative. Another major pillar of the system is the rise of clearinghouses, institutions created after 2008 to reduce risk. They centralize contracts so that instead of Bank A dealing directly with Bank B, Both deal through a clearing entity. In theory, this reduces the chance of domino-style failures. In reality, it concentrates risk in a handful of institutions that have become too large to fail, too complex to unwind, and too interconnected to fully understand. A failure at one clearinghouse could freeze global markets in seconds. Yet these entities operate with far less transparency than banks, and with significant reliance on the same margin systems that triggered chaos in past crises. The final and most dangerous ingredient is unpredictable human behavior. No model can anticipate what happens when fear replaces confidence, when markets move too fast for margin calls to be met, or when liquidity evaporates. The system is built on mathematical assumptions, volatility, correlations, and historical patterns that only hold in calm environments. Once panic sets in, those assumptions break instantly. A single shock can force institutions to unwind positions rapidly, which then triggers more shocks, more margin calls, and more forced selling. This feedback loop is what turned the 1987 crash, the 2008 collapse, and the 2020 liquidity freeze into global crises. But today, the stakes are exponentially higher. And here is the most important truth. The world cannot simply turn off derivatives. Governments cannot ban them. Banks cannot abandon them. Corporations cannot operate without them. Derivatives have become the circulatory system of global finance, invisible, essential, and dangerously overextended. The time bomb cannot be defused because the mechanism it is built into is the same mechanism that holds global markets together. All we can do is understand the structure, recognize the pressure building inside it, and see the early signs of a spark. And those sparks are already appearing in interest rate volatility, sovereign debt stress, and liquidity shortages. In Part 3, we uncover the triggers that could ignite the entire system. Every financial collapse begins with a spark. Not the collapse itself, that comes later, but a single trigger that exposes the fragility built into the system. When we talk about a 600 trillion derivatives web, the question is not if something could ignite it, but what will strike first. And today, the world is facing multiple overlapping threats, each powerful enough to destabilize the global financial architecture on its own. Together, they form the perfect storm, a convergence of economic pressures, geopolitical tensions, and structural imbalances, unlike anything seen in modern financial history. The first and most immediate trigger is interest rate volatility. Derivatives tied to interest rates make up the majority of the $600 trillion system. These instruments were designed in an era of predictability. When central banks moved slowly, inflation was low and growth was steady. But that world is gone. Rates have swung violently in just a few years, rising at the fastest pace in 4 decades and then entering cycles of sudden pauses and abrupt reversals. Every sharp move forces banks and institutions to meet massive margin calls. A single unexpected rate shock, especially in the US, Europe, or Japan, could create liquidity demands so large that major institutions simply cannot meet them. If even one fails, the counterparty chain begins to fracture. The second major trigger is sovereign debt stress. Countries across the world are carrying debt loads once considered impossible. Japan's debt-to-GDP ratio is near 260%. Italy approaches 140%. The US is adding debt faster than at any time outside world wars. When governments reach these levels of indebtedness, the cost of servicing that debt becomes unmanageable, especially when rates rise. Derivatives tied to government bonds become extremely sensitive. A sudden loss of confidence in even one major sovereign borrower could send shockwaves across global collateral markets, freezing the lending channels that banks rely on to function daily. In a derivatives-heavy world, a sovereign scare is not a localized crisis, it is an earthquake. The third trigger lies in commercial real estate, especially in the United States and Europe. Office vacancies have surged due to remote work, property values have collapsed in key markets, and refinancing waves are approaching with higher rates and lower valuations. Many institutions used interest rate and credit derivatives to hedge or enhance returns on these assets. If commercial real estate undergoes another sharp decline, the losses will not stay confined to property owners. They will spread into the derivatives built on top of the loans, securitizations, and structured products tied to them. This could spark a chain reaction similar to 2008, but larger and more globally distributed. Another powerful spark comes from currency volatility and geopolitical fragmentation. As global alliances shift, countries are reshaping trade flows, competing for technological dominance, and engaging in financial warfare through sanctions, capital controls, and reserve diversification. Currency markets, once highly liquid and predictable, are now prone to sudden swings. When currencies move too quickly, institutions with large hedged exposures, exporters, importers, global banks, must rapidly adjust their derivative positions. A sudden devaluation or sharp appreciation in a major currency such as the yen, euro, or yuan could trigger enormous losses across the financial system in seconds. But there is a far more subtle trigger almost no one talks about: the clearinghouse stress failure. Clearinghouses were built to protect the system, yet they have become single points of concentrated risk. If a clearinghouse faces margin shortfalls, cannot process collateral fast enough, or encounters multiple member failures simultaneously, it may halt operations. A temporary halt would freeze trillions in financial contracts. A prolonged failure would be devastating. It would mean that the safety valve of the entire derivatives market has broken, something regulators quietly fear but rarely discuss in public. Perhaps the most unpredictable trigger, however, is human panic amplified by automation. Modern trading systems rely on algorithms, high-frequency strategies, and machine-optimized execution models. In normal conditions, this makes markets efficient. But in moments of stress, algorithms can accelerate volatility rather than dampen it. Automated systems can withdraw liquidity instantly, creating air pockets in the market where prices collapse without buyers. Human traders, seeing the sudden moves, panic and begin unwinding positions. This combination, algorithmic speed and human fear, is capable of producing systemic shocks faster than regulators or institutions can respond. When these triggers converge, interest rate instability, sovereign stress, collapsing real estate, currency shocks, clearinghouse problems, and algorithmic panic, the system enters a zone where even a small disruption can become catastrophic. The derivatives market magnifies every movement. Liquidity dries up. Collateral becomes scarce. Margin calls hit simultaneously across institutions and continents. The perfect storm forms not from a single disaster, but from the synchronization of stress across all critical components of global finance. In Part 4, we explore what happens after the ignition. Not speculation, but the real-world chain reaction that follows once the first domino falls. And before we move forward, remember, if you have questions, doubts, or your own perspective on these warning signs, share them in the comments. Your insight helps shape the next videos in this series. A financial meltdown does not begin with explosions. It begins with silence. A brief moment when markets freeze, screens stop updating, and institutions hesitate because something feels off. In a derivatives-driven system, that silence is the first sign that liquidity has vanished. And once liquidity disappears, the architecture of global finance begins to unravel so quickly that even central banks struggle to understand what is happening in real time. A derivatives meltdown is not linear. It is a chain reaction, a synchronized collapse where the failure of one part of the system instantly magnifies stress everywhere else. The first visible sign would appear in the funding markets, the short-term lifeline banks use every day to borrow and lend billions. As soon as one institution fails to meet a margin call, lenders pull back. Overnight lending volumes collapse. Interest rates for short-term funding spike violently. Banks that depend on daily financing suddenly find themselves stranded. This is where the meltdown truly begins, not in stock markets, but in the essential plumbing no ordinary person ever sees. The moment funding freezes, the system stops functioning as designed. Almost immediately, the next phase detonates: collateral evaporation. In a derivatives crisis, collateral is king. But when asset prices fall rapidly, whether government bonds, corporate debt, or currency reserves, the value of that collateral shrinks. Institutions that once appeared well capitalized suddenly have enormous gaps. Clearinghouses demand more collateral. Banks rush to sell assets to meet those demands. But everyone is selling at the same time, driving prices down further. This accelerates the crisis like a financial feedback loop. Falling prices trigger margin calls. Margin calls trigger forced sales. Forced sales trigger even lower prices. Behind the scenes, counterparty chains begin to fail. When one institution cannot honor its obligations, the ripple effect is immediate. A failed derivatives payment in London affects a bank in Frankfurt, which impacts a pension fund in Toronto, which disrupts a corporate hedging contract in Singapore. These entities may have no relationship, no direct exposure to one another, yet they are linked through the invisible web of derivatives. The failure of a single counterparty can cascade across continents in minutes. And because derivatives are leveraged, every missed payment represents exposure many times larger than the underlying loan or asset. At this stage, regulators attempt intervention. Central banks inject liquidity. Governments hold emergency meetings. But derivatives crises behave differently from traditional banking shocks. They move too fast, they are too interconnected, and they exist largely in the shadows, outside public markets, and beyond the visibility of most regulatory tools. When clearinghouses become overwhelmed, even the strongest institutions feel the tremors. Clearinghouses may increase margin requirements dramatically or temporarily halt operations. Either action triggers chaos. Margin hikes force additional liquidations. Halts freeze trillions in obligations. In both scenarios, the crisis deepens. As the meltdown spreads, global markets decouple from fundamentals. Stocks crash, not because companies are failing, but because institutions must liquidate everything to survive. Safe haven assets like US Treasuries behave erratically. The dollar may surge or collapse unpredictably. Currency pairs that normally move gradually begin to swing violently. Algorithms detect instability and pull liquidity, amplifying volatility. Traders watch price charts behave in ways that defy logic. It becomes clear that markets are no longer reacting to economic reality. They are reacting to forced liquidation and systemic stress. In the real economy, the impact is immediate. Corporate credit lines freeze, trade financing collapses, businesses cannot roll over their debts. Multinational companies suddenly struggle to hedge currency exposure. Even a short-lived derivatives meltdown can paralyze global trade within days. Consumers feel the shock when credit card rates spike, mortgage markets seize up, and banks quietly restrict withdrawals or impose limits. Panic is no longer confined to trading floors, it spills into the public sphere. Governments respond with extraordinary measures: emergency liquidity injections, coordinated central bank actions, temporary bans on short selling, and even nationalizations. But these measures address symptoms, not the cause. The true cause, a derivative system too large, too leveraged, and too interconnected, cannot be unwound without enormous economic pain. Policymakers must choose between two catastrophic outcomes: allow the contagion to spread, or intervene with unprecedented bailouts. Either choice reshapes the global financial order. Yet perhaps the most dangerous phase is the psychological one. When trust breaks, the financial system loses its foundation. Investors question the solvency of banks. Corporations question the stability of currencies. Ordinary people question their savings. Trust is rebuilt slowly, sometimes over decades, but it can evaporate in a single week. And once a derivatives meltdown destroys confidence, no central bank policy can restore it quickly. Before we enter the final part of this documentary, take a moment to reflect on the complexity of what we've explored. If you have questions, doubts, or a different angle on how such a meltdown might unfold, share your thoughts in the comments. Your input deepens this community and helps guide future episodes. The truth is simple. The world is not ready. Not governments, not banks, not corporations, and certainly not regular people. The $600 trillion derivatives machine has grown so massive, so interconnected, and so dependent on constant stability that any sharp shock would send tremors through every layer of the global economy. And unlike 2008, we no longer live in a world where central banks can simply print their way out of a crisis without consequence. Back then, inflation was tame, debt levels were manageable, and political unity, at least compared to today, was strong enough to support coordinated global action. None of those conditions exist anymore. If the time bomb ever detonates, the first consequence will be confusion. Markets won't understand what is failing or why. Indicators will contradict each other. Politicians will issue statements that calm no one. Algorithms, which now dominate trading, will accelerate the panic, selling anything that looks remotely risky, amplifying volatility at a speed no human can control. This is the moment when trust evaporates, quietly at first, then suddenly. For everyday people, the fallout would appear in the things they rely on without ever thinking. Banks limiting withdrawals, credit lines disappearing, mortgage rates spiking, food and energy prices rising in days instead of months. The globalized supply chain, fragile even in normal times, would snap under the pressure. A derivatives meltdown is not just a financial crisis. It is a crisis of logistics, confidence, and basic economic functioning. Governments will try to respond, but they will be fighting a fire with no clear source. Do they bail out the banks? Do they nationalize failing institutions? Do they freeze markets? Every solution will create a new set of problems. Printing trillions might stabilize markets temporarily, but it would also ignite inflationary pressure that many countries are already struggling to contain. And politically, the world is more divided than at any time in the last 50 years. The trust required for global coordination simply doesn't exist. So what happens after the initial shock? Two forces will reshape the world: adaptation and realignment. Adaptation begins with individuals and companies. Businesses will be forced to rethink risk completely. The obsession with leverage will fade. Cash reserves will become essential. Households burned by volatility will move towards simplicity, lower debt, more savings, diversified income. Governments will face pressure to regulate derivatives in ways they avoided for decades, not because they want to, but because political survival will demand it. Then comes realignment, the long-term transformation. Power will shift toward nations with stronger balance sheets, domestic supply chains, and real productive output. Countries dependent on external financing or massive leverage will face a painful adjustment. The global monetary order may tilt toward multipolar systems, with trade increasingly denominated in local or regional currencies. The US dollar will still carry weight, but its dominance will face unprecedented challenges. Eventually, after the chaos, a new financial architecture will emerge, leaner, more transparent, and more cautious. But reaching that point will require passing through the fire. The derivatives machine cannot simply unwind. It must break before it resets. And when it does, the world will have to decide whether it builds a system that serves real economic growth or simply constructs a new tower of leverage waiting to collapse again. In the end, this isn't a story about derivatives. It's a story about human nature, our desire to push boundaries, to maximize profits, to believe that stability is permanent. The $600 trillion time bomb is the result of that belief. And whether it detonates tomorrow or 10 years from now, the consequences will define the next era of global economics. Before we close, let me know your thoughts. Do you believe the world could survive a derivatives meltdown, or would it reshape civilization as we know it? Share your perspective in the comments. Your view might inspire a future episode. If you haven't subscribed yet, make sure to join us. We release daily geopolitical and financial deep dives that help you understand the forces shaping our future.